All right, let's just get right to it. The most successful part of your portfolio? It's actually a huge problem. Yeah, you heard me. It's a warning sign that your strategy is broken, and if you just ignore it, well, it will eventually break you. So here's the paradox in a nutshell. The best performing part of your portfolio is often the first thing you should sell. I know, that just feels wrong. It goes against every single instinct we have about winning, right? But trust me, getting your head around this is the difference between actually building long-term wealth and just getting lucky for a little while. So why on earth would you sell your best asset? It's a great question, and the answer is all about shifting your mindset. See, you're not a gambler trying to predict the future. You're more like an architect, building a structure that's designed to withstand any storm. Selling your winners isn't about giving up, it's about sticking to your original blueprint. And this discipline, this whole idea has a name: rebalancing. Okay, so what exactly is rebalancing? Well, here's the official take, based on the SEC's definition. It's the process of bringing your portfolio back to its original target. You're making sure it doesn't get too heavy in one area and take on risk you never intended to. It's basically a rule-based system. It forces you to sell what's done really well, the stuff you have too much of now, and buy what's done poorly, the stuff you're now underweight on. You know what that is? It's a system for automatically selling high and buying low. Pretty smart, right? All right, let's talk about the risk you don't see, because this is how success can quietly make your portfolio really, really dangerous. Let me walk you through a super common scenario. So imagine you start here. This is your plan, a perfectly balanced portfolio, 50% stocks for that growth and 50% bonds for some stability. This mix is perfectly matched to your comfort level with risk. This is your blueprint. And then the stock market just has a fantastic year. Your stocks, they just take off. Everything's going up and up. On paper, you are making a ton of money, and man, it feels good. But underneath the surface, something else is happening. And bam, your reality is no longer your plan. Your portfolio has drifted. Now, look at this. Without you doing a single thing, you're suddenly holding 70% stocks. You didn't choose to take on this much risk. Your own success chose it for you. And that, right there, is the hidden danger. And this is what that hidden danger actually looks like in numbers. Just look at that risk column. It's measuring volatility, how wildly the price can swing up or down. You can see large stocks have a volatility of almost 20%, while government bonds are way down there under 10%. So by letting your portfolio drift to 70% stocks, you've basically doubled down on the potential for huge swings. You've accidentally become a much more aggressive investor, and you probably didn't even realize it was happening. Okay, so if this is all so logical, why is it so incredibly hard to actually do it? Well, it's because our brains, they're kind of wired to sabotage us. We have these cognitive biases that fight us every step of the way. And here's trap number one: recency bias. It's this tendency we have to believe that whatever just happened is going to keep happening forever. So when a stock has been going up and up and up, our brains stop seeing risk and start seeing a sure thing. We take the recent past and just project it way out into the future. And check this out. This shows the trap playing out on a global scale. For the last decade or so, U.S. stocks have been the clear winners, and recency bias makes us think, oh, this is just how it is now, it's permanent. But history shows us that market leadership is always changing hands. I mean, if this was 1990, we'd all be saying the exact same thing about Japan. Believing this time is different might just be the most expensive phrase in all of finance. Okay, trap number two is a big one: loss aversion. Basically, our brains are wired so that the pain of losing feels about twice as strong as the pleasure of gaining. So think about it. When you sell a stock that's been winning, what do you create? You create the possibility of a new kind of loss, the regret you'll feel if that stock just keeps soaring after you sold it. And to avoid that potential pain, we just do nothing. We just hold on, hoping the good times keep rolling, and our disciplined strategy turns into just a game of hope. So let's be real for a second. You can't control the market. You can't predict which country is going to be the next big winner. You have no idea when a bubble is going to pop. Trying to do any of that is just a fool's errand. So what can you control? The one thing you have power over is your risk. And this is the realization that changes everything. The entire game of long-term investing really just comes down to this one rule, and it's this: your portfolio should reflect the lower of what you can emotionally handle and what you can financially afford to risk. See, its number one job isn't to get the absolute maximum return. No, its job is to manage your behavior when things get scary so that you can stay in the game long enough for your money to actually grow. So, how do you actually enforce that rule? You do it with a system, a mechanical process that has zero emotion, rebalancing. That is the system that protects you from your own worst enemies, fear and greed. Think of it like a pre-commitment you make to your future self, promising that you'll always stick to your plan and not get swayed by the market's latest mood. Okay, so let's actually build that system right now. And don't worry, it's not complicated. A really simple, strong process is all you need to take all that emotion out of the equation. It's really just 3 steps. First, set your target allocation, your blueprint. Is it 60-40, 80-20? Whatever it is, that's your target. Step 2, choose your trigger. How will you know when it's time to act? You could do it on a schedule, say every year on your birthday, or you could use a threshold, like anytime one part of your portfolio drifts more than 5% from its target. And third, and this is the most critical part, you have to execute it mechanically. When that trigger hits, you act. That's it. No second guessing, no checking the news, you just execute the plan. Because ultimately, it all comes down to this one question. Are you actually building a portfolio, or are you just buying a lottery ticket? Letting your winners run wild without a system, that's not a strategy. That's just hoping you get lucky again and again. A real portfolio is built with intention. It's maintained with discipline. It's designed not just to thrive in the good years, but to survive the bad ones. So which one are you building?